I'd like to say good afternoon, good morning to everyone. Thank you for joining. For anybody who doesn't know, my name's James Bogart. I'm Managing Principal of Bogart Wealth. Forgive me, this is my first time doing a webinar of this scale, but we do have a couple administrative things real quickly. There's a Q&A box at the top that if there's any questions along the way, I have it open here ready to answer questions. If I can't get to it, I will come back at the end and make sure that I answer all of the questions. There's also a chat functionality so that I can see it as well. I'll do my best along the way. So Bogart Wealth is a registered investment advisory firm. We are fully independent. Clients who work with us have their assets custodied at Charles Schwab. Our core competencies are financial planning, investment management, and tax optimization. There are 14 of us on our team, and truthfully, I wanted to give a big level of accolades to my team. The last couple of weeks, as everyone knows, has been extremely volatile, and they've been working very, very hard to help us out. We have 3 offices, one in McLean, Virginia, one in Houston, Texas, and then one in the Woodlands, Texas. The Woodlands, Texas office is actually in the ExxonMobil buildings, very conveniently located for anybody who'd like to do an in-person meeting when we're back to more of a normal environment. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. What we like to say is your kids and your parents, more often than not, don't have the resources necessarily to have access to certified financial planners. We've made it part of our firm's culture to give your children access to CFPs. You know, I frequently will say, what do you know? What would you do differently now that you know what you know, but when you're back in your 20s? You know, a lot of times it's helping with things like how to set up their 401ks, where should they be saving, if they're going to get a mortgage or something like that. We've made that all part of our firm's culture. Part of our culture also is to educate. So we do 8 different seminar series along the way. One's called the Retirement Planning Timeline. One's the Retirement Income Planning Seminar. One's Social Security and Social Security Strategies. One's Tax Planning and Tax Optimization Strategies. One's on Estate Planning Strategies. Then we have another one on Net Unrealized Depreciation and Post-Retirement Strategies. One on Long-Term Care and one on Long-Term Care and Long-Term Care Insurance. And then last but certainly not least, it's Roths versus traditional 401ks and IRAs. Now, this list came from our audience, and I will say, you know, the call to action for any of the events that we do, we really do have a great passion on educating, but you'll hear me today talk about the need to have a plan. And if anyone hasn't taken us up on the opportunity to do that, absolutely no cost, absolutely no obligation. We're more than happy to be a resource, help you educate yourself on your situation, but also look at where things are at, especially after the last couple of weeks. So today, we were actually originally going to be doing our NUA talk today in person. I would say for the foreseeable future, we're not going to be doing live events. I'm going to pivot and do these web-based events. And based upon the level of attendance that we've had today, we've got about 165, 170 people at this one. I'd say that web-based might not be a bad solution going forward. But what my real goal today was to kind of summarize a lot of the discussions I've been having, and as well as the other advisors in the firm have been having, and really answering the question of, can I still even afford to retire? So I'm going to spend a little bit of time talking about the interest rates, specifically the discount rate associated with the ExxonMobil pension program. I'm also going to talk about how will the recession affect retirements, how to generate some income in a recessionary environment, and then also talk about some tax optimization strategies to take advantage of the environment that we're in right now. And then I'll talk about ExxonMobil stock, and then I'll wrap it up. And then at the end, if I haven't answered anyone's questions, I'll make sure I get to them. So let's just jump right in to talk about this current interest rate environment and how it's actually going to affect retirement. So to take a little bit of a step back, in 2006, the Pension Protection Act was established. And what this did was it established the guidance and rules associated with any company that was offering a lump sum benefit option. Might not be a huge surprise, but a lot of companies were offering a lump sum option, but it was dramatically underfunded. And so what it did was it established the rules associated with how to calculate a lump sum benefit. So it defined the discount rates that can be used to calculate the lump sum. It defined the actuarial table to be used for the lump sum. but it also clarified a couple other things. So for example, it clarified that non-spousal beneficiaries can inherit IRA accounts or rollover accounts. It also clarified that after-tax balances, specifically the tax paid credit balances, can roll over to a Roth IRA. It also clarified that company matches can be diversified. So many of you might remember up until 2006, in order to get the extra 1% on your match, you had to buy stock. After 2006, it was now allowed to be diversified and still get the benefit of the extra 1%. And then the last thing that the Pension Protection Act of 2006 clarified was it defined IRA and 401k contribution limits. So ultimately what ended up happening is now there's two categories of households at ExxonMobil. Those that are considered quote unquote grandfathered, meaning you had the legacy series of rules that ExxonMobil was applying for your pension lump sum benefit, and then there's everybody else. So to be in the grandfathered category, you had to be over 50 by the end of 2007 and had more than 10 years of service before January 1st, 2008. And for anyone that's in this category, there was no change in the rules. To kind of make it a little bit easier, you had to be 55 or had 15 years of service by December 31, 2012, or born before 1958 and hired before 1998. Now the math for you guys is pretty simple. We use 95% of the 30-year Treasury rate, and it rounds to the nearest quarter point. We also use the ExxonMobil 2000 mortality table. Now, the 30-year Treasury rate all Treasury rates, to be honest, have been extremely volatile over the last couple of weeks. As of the 20th, the 30-year Treasury rate was at 1.473. It's actually gone down a little bit. And here's a chart that's kind of indicated what the Treasury rate itself has done. And as you can see, for the last 4 years, it's basically been more on a downtrend. Now, Pete in our office has built some really fantastic tools to help us with projecting what the future discount rates are going to be for anybody that's in both categories. But for the grandfather category, we know that the first and second quarter were at 2.25%. And now we have a couple days left in the quarter, but we are very firmly entrenched that we're going to see 1.75% for the discount rate for the grandfathered category. Now, as of Friday, there were 8 trading days left, but in order for the 30-year Treasury rate to stay at 2.0, rates would have had to have been, the 30-year Treasury rate would have had to have been above 2.18 in order to round up to 2.0. And to round down to 1.5, it's not possible, but the 30-year Treasury would have to be 0.1441%. One of the big questions I'm getting is, now that we're projecting 1.75, which a lot of you can probably see that's the lowest discount rate that has ever applied for the grandfather category. What's the fourth quarter discount rate going to be? And candidly, it's very hard to predict that. I will say that with the current 30-year Treasury rate at 1.4, yeah, there's a chance that we could see it get rounding down to 1.5 in the fourth quarter, but we're not even in the second quarter yet. So April through July will determine what the fourth quarter rates are. I will say, based upon the actions the Fed's been taking, the Treasury rates have kind of been propped up a little bit. Ultimately, I would say for planning purposes, I think it's probably safe to assume it's either going to be 1.75 or 2.0% for the grandfather category. All right, so let's talk about everybody else. Now, everybody else was essentially those who were under the age of 50 before December 31, 2007. And so these are the folks that now are subject to the Pension Protection Act of 2006. So it's new pension rules that apply. Now, for this category, there are 3 segments of rates, and these are all based off of high quality corporate bond yields. I did include the link takes you right to the IRS website that publishes these every single month. And there's essentially a segment 1, which is mirroring short-term rates. It applies to the first 5 years after someone retires. Segment 2 is the next 15 years. It's supposed to be more intermediate term rates. And then segment 3 is any time that's left between the preceding 20 years and then up to what the IRS is predicting your mortality to be. And segment 3 is long-term rates. It's the highest of the rates. Now, because these are corporate bonds yields have been higher than Treasury rates, and higher yields obviously are bad compared to Treasuries. But the other part for the 2006 Pension Protection Act is they clarified the IRS mortality table. Now, this has been updated every single year. And so what we've seen is for the grandfather category, I mentioned that they used the ExxonMobil's 2000 mortality table. Now, that hasn't been updated since the year 2000. The IRS mortality table is now 20 years later, and people are living longer. So longer life expectancy is good. Obviously, we started seeing people who were retiring, in 2013. And these were individuals that were born after 1957 or hired after 1997. Now, this is part of one of the tools that Pete's also helped us build. This is showing the actual history of the three segments. And similar to the Treasury rates, we've seen a very quick decline of the corporate bonds in segment 1, 2, and 3, all the way up until last week. Now, last week, with the sell-off that happened in the markets, it also impacted bonds, which caused bond rates to actually go up pretty exponentially. And so we've also built a tool that shows the three different segments. And we are still predicting that the third quarter 2020 rates will be the lowest they've ever been. As of last Friday, they are going to decrease from the second quarter by 0.15. And you can see the two reflected right here. Now, the reason that there's a difference between somebody who's age 60 versus someone who's age 55 simply has to do with what is their exposure to segment 3. Part of the process for us is helping everyone build out the actual timeline in terms of what the discount rate impact will have on your lump sum benefits. The one thing that I would say is your pension lump sum decision is only one of the many decisions we need to make around a retirement. But in terms of how interest rates are going to impact lump sum benefits, the summary really ultimately is we're seeing rates coming down. And it's absolutely something that we want to be factoring in terms of decisions, but it's something to also be mindful that they could also go up. If the trajectory for the rates has been what it has for the last week, and based upon what's going on with the spreads with the bonds, there's a good chance that we'll see fourth quarter rates actually being higher than what they are in the third quarter here. Now, the next slide here, this is actually just giving a demonstration of the timeline. And so what I did was a hypothetical September 1st benefit commencement date. And so the earliest someone can request a benefit package is 120 days prior to their benefit commencement date. Now, this is also something we'll help every household individually customize, but if someone's targeting a September 1 retirement, May 1st is the earliest that you're going to be eligible to request a package. And then from there, it usually takes approximately 3 to 5 weeks to actually receive that package. But in order to get everything processed correctly on time, you need to actually have the package back to them by July the 24th, so approximately 35 days prior to your benefit commencement date. Now, end of August, early September, right around the 1st, you're going to see the checks coming in, whether it's your lump sum, if you have a supplemental pension or additional payments, all of that will come in right around the same time. And then anytime after that is where we actually would be eligible to do the rollover call. And this is just for illustrative purposes. You know, for a lot of households right now, based upon the volatility that we're seeing with the markets, we're actually recommending to leave the savings plan at Voya. And I'll talk about that a little bit more later, but you always have the default option. If you have other funds to be able to live off of, you can leave the savings plan at Voya as long as you'd like to, all the way up until typically when you get to the age of 72, when you have to take required minimum distributions. Someone just asked if I'll send a copy of the slides out. Yes, we're actually recording this to be able to send the presentation itself, and I'll also send the slides out. And this slide actually is probably one that's also very pertinent. This is just giving specific dates for that timeline that I just went through. All right, so how will recession actually affect retirement? And you know, the biggest thing that we're having a lot of discussions on right now is ultimately human emotion. And it's very easy to go through the full life cycle of human emotion, where you go from optimism up to at a high, you're in a euphoric state. And when we're in a period of time like this, we're more despondent, and ultimately it does start to trend back up. This is correlated very similarly to what's going on with the markets, you know, and ultimately what I see is a very good opportunity to look at where you are in terms of your emotional state right now, because we wouldn't want that to actually influence your ultimate investment decisions. And the reason we say that is because emotions, without a doubt, can destroy a plan. And this is both ends of the spectrum, whether it's fear or greed. Fear can absolutely lead to you making very bad decisions in a down market environment like we're in right now. But at the same time, too, greed can absolutely allow people to be overly optimistic or euphoric, where you're buying at highs and then ultimately, as you become fearful, you're selling at lows. Now, we wanted to just provide a little bit of statistics as to where we're at now and some of the history here. Not that history is the only thing that we need to look at in any market environment. And I will admit, this is a global pandemic that is impacting pretty much every aspect of the market. But we do look at history and we can see how markets have performed, especially in recessionary environments. This chart is from Morgan Stanley. It's from their Global Investment Committee's recent slide deck. It's as of February 28th, so it's not fully encompassing what's happened so far this month, but I'm going to focus more on some of the previous years. And ultimately, over the last 40 years, we've had 10 negative years on the S&P 500. But the big critical point with this is that every single one of the negative years, at some point in the year, was lower than where it finished out the year at. And I'm not saying that I think that 2020 is going to totally rally and be up for the year, because I do think that ultimately right now we're in a recession or eminently going to be in one. But at the same time, too, it's important to remember history, and it's important to remember how that impacts the decisions that we're making. And one of the big discussions we're having right now is people who go to cash. And so this is a slide that PIMCO put together, and it really nicely illustrates human emotion and how we make decisions. And when we're at absolute highs, from an investment perspective, we're so happy that we invested. And ultimately, we see kind of the initial phase of a correction. And next thing you know, it's, there's got to be a recovery soon. It can't get much worse than this. And then inevitably, we get to that environment where I can't take any more of this. I can't stomach the pain. I can't stomach the volatility. And yeah, it might go down a little bit more. And you get to that point where you say, you know what, I'm really glad that I did that. I'm sleeping better, whatever. But ultimately, as we start to see things turn, you then move into a state where it's, okay, this rally can't last. There's no way that the market can continue to go up from here. The news is way too negative. Jobless claims are going to skyrocket. There's no way that the market can keep going back up. And inevitably, people wait. And by the time they get back into the markets, they've missed a significant portion of the rally. And so this is really quantifying kind of the 06 to 2011 timeline, where you can see essentially, people wrote it up. They all of a sudden were feeling very good. That's typically when people start to invest a lot more money. Next thing you know, they take the initial hit, then we take the bigger hit, they panic, they get out. And by the time they get back in, the markets have already had their recovery. And ultimately, that does have a very negative impact on a portfolio. Now, I'm not saying going to cash or reducing risk is not a bad thing. What I'm saying is be very mindful of your emotional state and what impact that's having on your investment decisions along the way. And throughout history, this is a chart that's just going back the last 10 years. We've had a lot of reasons to sell. I sent this out in one of the commentaries we sent a few weeks ago, and it's a little grainy, I apologize, but there's been a lot of bad news along the way. And you can see, where coronavirus is right now. But the one key takeaway I would take from this slide is, even though coronavirus has absolutely wiped out 2.5 years worth of gains across the equity markets, we're still higher than where we were 10 years ago. And when you're setting up your portfolio, it's really important to understand what you're okay taking risk with, what we need to be using to generate income, and then what we need for short-term liquidity needs. And so part of it is ultimately developing your plan. One other point that I wanted to make real quick, this is another one from Morgan Stanley, but this is looking at the S&P 500. And again, it's going back on a 40-year timeline. But if you did not miss any days invested and you just owned the S&P 500, your average return from 1990, excuse me, I said 40 years, it's 30 years, from 1990 until 2020 is 9.6% per year. If you miss the best 15 days, your return drops to 6.4%. If you miss the best 30 days, it dropped to 4.1. If you miss the best 45, 2.1, the best 60, 0.4, best 75, you're now down 1.2, and the best 90 days, you're actually down 2.7%. So the point ultimately is where you're okay taking risk, and assuming we've satisfied liquidity needs, assuming we've satisfied what your short-term goals are, there should be a portion of your portfolio, and everyone's risk profile is going to be different, but there should be a portion of the portfolio that does have more ballast points that's going to be okay being more volatile along the way. So ultimately, you know, part of the discussion and probably one of the biggest takeaways from today is retirement planning itself is a process. It's not an event. And because of that, the ultimate baseline for anything that you need to do, you absolutely need to have a plan. Analyze your retirement needs. You also need to understand investment strategies. You need to understand withdrawal strategies. And you also need to have mechanisms in place to review and monitor, make sure that you're online with your plan. You know, what I find is a lot of advisors use planning as a way to meet people, but ultimately it gets put on a shelf and it never gets brought back up. You know, I think that it's very important that you hold the plan as the ultimate accountability point. It's not only that what they're doing in terms of what your accounts are doing in terms of performance, but it's how are you doing with spending and making sure that that's part of the overall way of analyzing your asset allocation and portfolio needs. All right, so I'm going to start to transition to talk about how do we generate income in a recessionary environment. Now, it's really important to remember what are your income sources first and foremost. So, for example, Social Security. I think you ultimately have to believe that Social Security is real, but at the same time, too, Social Security was never designed to replace 100% of anyone's income. You know, theoretically, it'll replace 90%, and then on the other end of the spectrum, theoretically, it could replace 0% if you have unlimited income. But for the U.S. median income, it replaces approximately 40%. For the typical ExxonMobil household, it's replacing anywhere from 10 to 30%. And how do we get to these numbers? Well, here's where we look at the Social Security replacement ratio. So if you're able to live on $11,520 a year, you're able to use Social Security to replace 90% of your needs. If you live on $69,420, Social Security will replace 42% of your needs. If you live right at the maximum wage base, so where Social Security maxes, your Social Security contributions max out, which is $137,700, it'll replace 27%. And then if you're living on anything more than that, the percentage starts to decline. And so that's why we have the range of the typical ExxonMobil households anywhere from 30% to around 10%, depending upon how much you're spending. So that's Social Security. Now there's also the pension program. Now, the pension program also was never designed to replace 100% of anyone's income. The fixed annuity will replace on the low end 12%, and this is somebody who is retiring right at the age of 55 and has exactly 15 years of service. So on the higher end, it'll replace 65% of service, of earnings, excuse me. So 65% would be somebody who's into their 60s, has over 40 years of service, and their spending needs are typically less than what the replacement ratio would be from the pension. But the formula itself is actually very simple. It's 1.6 times years of service times your average pensionable pay minus the Social Security offset. What we found for the typical ExxonMobil employee, it does replace about 50% if you're retiring at the age of 60. Now, I did include this slide here. This is actually the legacy pension calculator that they used to use. It's a little dated, 2007. But the reason I like it is because it actually shows the formula itself right here. So 1.6 times years of service times average pensionable pay, less the Social Security offset, that gives a single life annuity. We then apply discount rates to it, and that's what gives us the ultimate lump sum number. ExxonMobil's tools have gotten a lot more sophisticated over the years. It's now a web-based tool, relatively simple to use, but if you have any questions or need help with that, we're more than happy to direct you on how to use that tool. Now, the other question we get is, should we consider delaying our pension, or what is the impact of continuing to work on the pension? So first thing I'll talk about is someone right at 15 years of service. So the reason we say 15 years of service is because that's the earliest you're eligible to be having a lump sum option. And so if you retired right at 15 years of service at age 55, as I already mentioned, that's going to replace about 12% of what your earnings are. Now, we will see a 5% increase every single year between the ages of 55 and ages of 60, because ExxonMobil does apply a early retirement discount for anyone who retires under the age of 60. But theoretically, if you retire at age 58, right when you hit 15 years of service, you're going to replace about 19% of what your earnings are at that point. Now, for the lifers, as we like to call them, or those that have additional years of service. So for example, if you retire at 55 with 33 years of service, you're going to get approximately 33% of your earnings replaced. Now, the decision to delay, and delay meaning continue to work or just retire and then leave it and accumulate. So if you retire and at 55, excuse me, and then just leave it, you're going to actually benefit from 5% increases each year by leaving it until the age of 60. Now, after 60, it makes absolutely no sense. But if you continue to work, you're actually going to get a little bit of an uptick because you're continuing to have additional years of service. So you'll see about an 8% per year increase all the way up until the age of 60. And now all of a sudden it's a flat 3%. Now, the one thing that this does not bring into the equation is what is the impact of interest rates on the lump sum benefit. So yes, you have the ability to retire at 55, leave the pension at ExxonMobil, and wait until you're 60 to eliminate that 5% per year discount. But as I talked about a little bit earlier, interest rates absolutely will have an impact on the pension benefit if you're going to take the lump sum. And one thing that we want to be mindful of is if we're in a rising interest rate environment, you want to understand what the financial implications are. If your intent is to get the lump sum, it's all well and good to get the guaranteed 5% from delaying it. But if we're seeing massive interest rate movement, which at some point in here we will, it's hard to say when it'll be, but if we do, that can absolutely be more than detrimental than the 5% benefit you would get just from leaving it there. So something to be mindful of. It's not the ultimate driver decision, but that's also something that we're more than happy to help with. But let's just say that we've got Social Security that's going to replace 10% of your income. We've got the pension designed to replace approximately 50% of your income. Well, that's about 60% of what you need to live on. Now, I don't know a whole lot of people that retire and all of a sudden say, I want to live on 60% of what I was earning. They don't. And so what that ultimately means is that that remaining 40% needs to get made up for with other investments, which would be your IRAs, 401ks, TSPs, any after-tax assets, things that you're saving there. So that's where we need to encourage saving, and we need to continue to encourage saving even in a more volatile market environment. But at the same time, too, it's really important to understand investment strategies more in their entirety. So what I'm going to do is talk about just 5 of the basic strategy elements for investing a retirement portfolio. My intent is not to recommend any one of the specific ones because every person's risk profile, income needs, tax needs are going to be very, very different. But it's important to understand what are the options and ultimately use that to help you determine what your strategy should be. So the first option we talk about is annuities. And I'll talk about fixed annuities, index annuities, and variable annuities. Then we'll talk about bond ladders and what those are and how they're structured. Then I'm going to talk about income-oriented investments, whether it's going to be big dividend blue chip stocks, or it might ultimately be some type of bond, and we'll talk about those. And then I'll talk about more of a fixed asset allocation model. And this is very reminiscent to what a lot of people call modern portfolio theory, or just indexing, where we buy index funds and then just rebalanced over a fixed period of time. And then I'm going to talk about more of a what we call a dynamic asset allocation model. Every one of these strategies has pros and cons. I'll try to make sure I address all of them. But it's important to understand different philosophies, as different advisors will present different options to you. So when it comes to annuities, and I will say at the default, depending upon someone's risk profile, ExxonMobil has been very nice in that they have structured it so that you don't have to have 100% lump sum or 100% annuity. You can do a combination. You can do 75% lump sum, 25% annuity, 50-50, 75% annuity, 25% lump sum. I think the ExxonMobil annuity program is a very viable option to consider if, depending upon your risk profile, you really want to have guaranteed income. I think it's something we should talk about, and it should be part of the overall investment strategy. Now, what I'll talk about here is actually annuities that are outside of the ExxonMobil benefit plans. So on the first column here, I'm going to talk about fixed annuities. The easiest way of kind of mentally describing them or thinking about them is they function a lot like bank CDs. They usually have longer time horizons. They are a fixed rate of return. So for example, you can buy a 5-year fixed annuity or a 10-year fixed annuity and lock in that rate. And it's also important to note that when you invest in a fixed annuity, your funds are in the general fund of the company that you're investing in. Now I'm going to flip over and talk about variable annuities, and I'll come back to index. Now, variable annuities are very similar to mutual fund portfolios that are within an insurance company. You do take on market risk with variable annuities, and they are also all owned within a separate account. So your account is separate and segmented from everyone else's. Now, the thing with variable annuities, as well as indexed annuities, to be honest, is you can get lots of different flavors of guaranteed income options or guaranteed growth options on them. That's all something that we could talk about as an option if that's appropriate for you. But when I come back to talk about index annuities, an index annuity is essentially a hybrid of a fixed annuity and a variable annuity. Their claim to fame right now is that you can get, like, for example, a percentage participation of the market on the upside with some level of cap or floor. So, for example, you might be able to get 7% participation up with the S&P 500, but no downside risk. That's an option. And frankly, in this type of environment, some people might really like to have that as an option for them because they won't see their principal value going down. So again, annuities are a strategy to consider. I would say that the biggest negative associated with annuities is the fees that come with them. And especially when we start adding in all of these different income benefits and riders. Sorry, my light keeps going out behind me. But we keep adding these different income benefits or riders onto them. That does increase the cost. So it's something to factor into the decision that you're making along the way. All right, bond ladders. Now, bond ladders, this is a very, very simple example, but it's trying to illustrate the point. This is an example of a 3-rung, 3-year bond ladder that's stretching out over a 6-year period of time. So for example, let's just say you have $300,000 that you want to have in a more conservative income-oriented environment. So we put $100,000 into a 1-year bond. We put another $100,000 into a 2-year bond. We put another $100,000 into a 3-year bond. As the 1-year matures, we buy a new 3-year. As the 2-year matures, we buy a new 3-year. As the 3-year matures, we buy a new 3-year. We keep investing the principal. But what we're using is the income that those bonds are paying as part of the cash flow strategy. Now, ultimately, the level of risk associated with bond ladders comes down to the companies that you're actually investing in and then the duration of the debt that you're taking on. Now, what we have found is interest rates have come down. Bond ladders have become less attractive because interest rates have come down, so the yields off these things aren't always appropriate for someone's risk profile. So when we talk about yields, and this is specifically talking about the cash flow that gets paid out to you. I did update them as of the end of last week, but bond ladders can range anywhere from 2.5% up to 5.4%. Now, 2.5% would be a more shorter term bond ladder, not necessarily taking on a lot of long-term interest rate risk. A 5.4% bond ladder would have a lot of 30-year bonds. That's a lot of interest rate risk. And what that means in terms of quantifying interest rate risk is bond prices and interest rates move inverse to each other. So as interest rates rise, you're going to see the value of those underlying bonds go down. Now, some people might say, I don't care because ultimately I'm going to own that bond until it matures at the end of 30 years or 10 years or whatever the bond is. And fine, I hear you. A lot can change, though, with a corporate balance sheet over a period of time that maybe that bond can all of a sudden become a little bit riskier. So longer duration bond ladders might not necessarily be appropriate. Now, we also talk about income funds. So there's corporate bonds. AAA rated corporate bonds are paying around 2.7. There's not a whole lot of AAA rated companies left. High quality investment grade bonds paying about 3.6%. Flexible income funds are paying about 6.4%. Mortgage bonds are paying anywhere from 2.2 to 2.7%. Foreign bonds, 0.3 to 1.6. And then we compare those to things like preferred stocks. Now, a preferred stock is paying, as of Friday, about 6.8%. But with preferred stocks, they're going to fluctuate too, just like a stock will. And so a lot of those preferred stocks are now down which is leading to their yields coming up. Same with royalty trusts. Now, a royalty trust would be like an energy partnership's an example of one. Limited partnerships, like pipeline companies are examples of royalty trusts, and they'll range anywhere from 7 to 19%. Obviously, the ones that are at the higher percentage, it's typically because the equity value has gone down, but they're paying a good yield. And if you still believe in the cash flow and their ability to continue to pay the cash flow, it might not be a terrible option to consider for a very small piece of someone's investment portfolio. And dividend stocks. Now, dividend stocks across the board in this environment have all been impacted with market fluctuations. We're seeing 3% all the way out to 10%. ExxonMobil got to an 11% dividend yield a couple days ago. Fortunately, we've seen a little bit of recovery on the stock. I'll talk more about that in a minute. But ultimately, we've got an environment right now where we've got some really, really high quality companies that pay very good dividends that are now down because of the market environment. That might be an appropriate strategy to consider for somebody. And I think it falls into the income category where, as we're talking about setting up a portfolio structure, we are going to need a part of the portfolio to be able to generate cash flow for you. And we compare all of this to current 10-year treasury. Current 10-year treasury is at, it's down a little bit today since I made the slides, but about 0.8454%. So treasury rates have come down dramatically. All right, I did want to present just one of these income-oriented illustrations, and the slide's a little dated. It goes through the end of 2018, but it does illustrate the point nicely. And so Pete helped build this one, and I got to give him credit for that. But when we compare ExxonMobil stock price, which is the red, versus one of the portfolios that we manage, which is called Prime Income, what we're doing here is comparing not only performance, but we're also comparing dividend yield. And a lot of investors say to us, you know what, I just want to continue to own the stock because the dividend's so solid and so good. And I would say, I hear you. Obviously, with maintaining a concentrated risk, you ultimately run the risk of what we've just experienced, which is ExxonMobil correcting, circa 50% in a month. Now the dividend yield on ExxonMobil as a percentage basis has gone up exponentially. I would obviously call the question, can they continue to sustain the dividend yield? And that's part of the conversation we're going to have. But what we're trying to do here is show you the history of ExxonMobil's dividend yield, which on the right chart here is in red, versus the history of Prime Income's dividend yield. And Prime Income is just one portfolio that Bogart Wealth manages. I am not necessarily recommending it across the board, but the point ultimately is ExxonMobil's dividend has historically been fundamentally solid. I would argue that now their financials are starting to dictate that they might have an issue with it. Why not consider ultimately, especially when you get to a price that you're comfortable selling it, being in a more diversified portfolio that also has a history of increasing its dividend, but also paying a more significant level of cash flow to you on a percentage basis. Now, Prime Income, again, it's one example. It's individual stocks that does bear risk. It's not immune to volatility. It's been down this year as well. Right now, it's paying about a 5.4% dividend yield, which is a little bit higher from where it was even a month ago, where it was in the 4.6 range. And it's down about 22% right now. So it's something to be mindful that, yes, individual stocks still bear risk. But when we go into this type of strategy, if we believe that those companies are still going to be able to sustain the dividend yield that they're paying throughout whatever type of market environment, we got to be okay giving them the latitude to go up and go down. As long as they're still paying the cash flow, we're ultimately going into it because of the cash flow strategy. And so just one option to consider or be mindful of or think about. All right, now I want to talk a little bit about strategy 4. And this is where we talk about more kind of the modern portfolio theory, diversified asset allocation approach. And the concept here is if we have a portfolio of 100% stocks versus a portfolio of 100% bonds, if we combine the two, we're going to get less overall risk than the portfolio. So this is a 50-50 mix right here with a more consistent overall rate of return. So it's the point here is that by diversifying your risk, there's going to be periods of times that bonds do better than stocks and periods of time that stocks do better than bonds. It's important to understand based upon your risk profile where you fall in that spectrum. But if we can smooth the amplitude, meaning have less volatility but getting a more consistent rate of return, that's also a strategy to consider. The one thing that I'll say about a pure static asset allocation is typically for a retired portfolio, we're needing to generate cash flow. And so when we're in a very static asset allocation model, where we're not necessarily bringing in income or cash flow needs for a customer, well, the problem with a static asset allocation model is that when it is down, like it is right now, the fear is that you're going to have to sell equities potentially in a down market. We would obviously lean on bonds first in that type of environment, but ultimately, depending upon what you're spending, we might have to be liquidating at an inopportune time. That's probably the big risk there. And then the last strategy we talk about is more of what we call a dynamic asset allocation model. And what this is it's really trying to portray what dynamic asset allocations are and how it reacts to different market environments. But to kind of help with demonstrating it, if you think about it, at the start of the 20th century, railroad stocks represented 63% of the US equity market and just 0.2% a century later. Russia, India, and Austria-Hungary represented 25% of the global equity markets in 1899 and less than 1% a century later. Now, there's also periods of time where you're absolutely going to see sustained drawdowns. What we're seeing right now is not the first time in history that we've had big market corrections. I would say that this one's unique because it's been created by a pandemic, but at the same time too, it's not the first time we've seen a recession or a prolonged period of time with down market environments. So dynamic is a process. It's not trying to time the markets. It's based off of actual trends, not beliefs or predictions. And what it's looking at is the flow of funds. It's ranking and scoring every single asset that you own relative to each other, but also relative cash. And what it's trying to do is factor in the impact from geopolitical concerns, economic upturns and downturns, industry and sector opportunities, interest rate changes, and ultimately align the asset allocation to be in the strongest possible positions. And this chart itself kind of demonstrates that, where and it's even hard for me to read the names of them, but recognizing not every year is every asset class going to be the best performer or the worst performer. For example, in 2019, cash was the worst performer. Right now in 2020, cash is the best performing asset class. But every single year you can see they all fluctuate and deviate based upon what's going on in the markets that year. And the whole concept of dynamic asset allocation is to be able to move your asset allocation to take less risk or more risk dependent upon the period of time or the market environment that we're in. What I would say in terms of the ultimate risk with dynamic is that, let's just say you get into a risk management mode where you start to reduce your equity exposure, and then all of a sudden we see a perfect V back up. And that does create risk. Like, for example, somebody who went to cash on Monday, as an example, and then next thing you know, we have a day like we did yesterday where the markets are up 11%. Well, that's a hit right out of the bat. So just something to be mindful of and appropriate for portions of the portfolio as well. All right, so asset allocation. And ultimately, we need to look at what your current asset allocation is, and we need to adjust accordingly based upon your risk profile and your investment goals. I would also factor in your cash flow needs as part of that as well. And today I'm going to talk about strategies for active employees as well as retired employees. But most active employees only look at their 401k balances right now, and they're getting very emotional based upon what they're seeing happen to their 401k. And as you know, there's a lot of 401ks that are down 30%. Some of them are down 50% right now. It's been a very brutal month. And at the end of the day, one thing that I would say that it's important to remember when you talk about the investment decisions that you're making long term is also remember that you have that pension lump sum as still a part of your overall asset. And it's not uncommon that that pension lump sum makes up a more significant portion of your investment portfolio than what you have in the 401k. And so where we're seeing this market volatility on the 401k, it's really hard to remember that you still have a very significant portion of your investment portfolio while you're still actively employed in a fixed income bond-like portfolio. And that's the same that holds true for somebody who's retiring. If you decide to take the annuity, well, based upon your risk profile, that might be the right solution for you. But if you decide to take the annuity, it's still important to remember that guaranteed income stream that's coming in as part of your overall investment allocation, because it does allow you to, and it might require you to, need to take more risk long term. But I also think it's really important, as you're talking about what your retirement portfolio looks like in its entirety, you have to be addressing your cash flow needs in line with what you're doing from tax strategies as well as overall comfort with investment risk. So next up is to talk about the withdrawal strategies. And there's different strategies associated with being able to withdraw funds in retirement specifically. You know, some of you might be fortunate enough to be able to do what's called income only. And what that means is you're withdrawing only the interest and dividends from your investments. And that's fine. Honestly, it's the very small subset of the people that we talk to. Most of them need at some point in time to withdraw some level of principal from their portfolios. So then the other strategies we talk about is a bucket approach, which is where we create very specific buckets. Some are going to be dedicated for short-term immediate needs. Some of them are going to be more of the next phase, which would be more the immediate needs. And then lastly is going to be long-term needs. And then the third strategy is more of a systematic approach where you just take a pro rata amount out of your portfolio. Doesn't matter if it's up, it's down, you're just taking out an equivalent amount each month, each year, each quarter. So here we just have a really basic illustration of the bucket approach, because we are very big advocates for the bucket approach for those that can't rely on just income only. So let's just say you've got 1.5 million of savings, you need $60,000 a year to live on. For a more conservative investor, we might say, all right, let's leave 5 years in a more short-term, safe parking place. It might be using some short duration bonds, might be using money markets. But if we know where the next 5 years worth of cash flow is going to be, and so in this example, it's going to be about $300,000, that should give you a tremendous amount of peace of mind that whatever is going on with the markets, it will be okay. You know, I already talked about sustainability and investing long-term, but if we know where the short-term money is coming from, then let the long-term portions of the portfolio do what they need to do. They are going to go up, they're going to go down. It happens, that's investing. But then we want to have the second bucket. The second bucket is where, in this example, we're targeting the 6 to 12-year money. And this is going to be where we rely more on income. It's going to be big dividend blue chip stocks. It's going to be some bonds, but we're really focusing more on a cash flow strategy with that bucket. And then the third bucket is where we are okay taking risk. Now, I'm not saying taking risk going to Vegas and putting it on black. That's not what I'm saying. But where we look at companies where we can see very strong balance sheets that we believe that they're going to be there at the end of whatever environment that we're in, and that they're going to be ultimately higher than where they are today, we should be okay considering that from a risk perspective. You know, there's a lot of stocks right now that I think ultimately are going to flourish under this environment. Not that this is a great environment by any means, but I think ultimately there's some that will come out of this in even better shape than they were when they went into it. All right. So next up, we're going to talk about how to review and monitor your process. And this really is not only while you're still actively employed, but also once you're retired as well. So we want to look at where your assets are at. Are they higher or lower than what we projected them to be? How is your income stream? Was your income estimate correct? Did you receive any unexpected cash flows, or did you have any unexpected spending habits? How did your portfolio do? Was your portfolio higher or lower than what we estimated it to be? Does your portfolio need to be adjusted or rebalanced based upon the market environment that we're in? That's truthfully one of the biggest things that we're doing right now, is assessing clients' needs and what the overall asset allocation model needs to be dependent upon what's just happened with the market. How are we doing with withdrawal rates? You know, does your actual withdrawal rate fall in line with the level of success that you're comfortable with? You know, typically what we find is anything higher than 4 to 5% withdrawal rates off of a portfolio absolutely will jeopardize the sustainability of someone's portfolio. You know, we do know that if we just use a 6% rate of return with a 3% rate of inflation, that a portfolio that is withdrawing on a 8% withdrawal rate, that's only going to last about 15% or 15 years, excuse me. So we need to be mindful of what is our actual withdrawal rate. Now, we build the portfolios to be able to sustain periods of time where the withdrawal rate might increase relative to what the underlying asset base is if the accounts are down. But at the same time too, it's important to understand from a long-term systemic planning perspective, what is your planned withdrawal rate going to be relative to your asset base? Next job's looking at inflation. Do you need to increase for inflation? And by the way, one of the things from a strategy perspective, as you're in retirement and you have a market environment like this, maybe ultimately the decision right now is we don't increase spending. We obviously absorb some of the inflationary impact on the cost of the things that we're buying by not doing a prorated increase on your annual spend this year. Help absorb some of the blow by using or reducing what your spending habits are. And then lastly, have your retirement goals and expectations changed? And I don't like ever having a conversation with someone that they need to be changing their habits based upon what the portfolios are doing. Typically what we find is we're changing habits or we're changing spending because someone has changed their goals and their expectations. Now, these types of environments, it's really important to rely on that plan and looking at it, where is it going to be not only in the next 6 months, 12 months, 5 years, 10 years, 30 years. And ultimately, if part of your plan is to leave a legacy, we need to have that discussion as well, especially right now while the assets are down. So that's part of what any advisor that you're working with should be considering and doing. All right, so I'm going to transition a little bit to talking about some tax optimization during market pullbacks. I'm going to talk about both from a actively employed perspective, but also from a retired individual perspective as well. But when the markets are down, one of the first things we typically see people do is they stop saving. First it's like, oh, if I'm going to put it in there and it's immediately going to go down, why would I keep doing it? No, let me encourage you to consider this whole concept of dollar cost averaging. Buy things as they're lower, continue to save, and at a minimum, maintain your current savings, but absolutely consider increasing if possible. One of the things that I find commonly happens is when you turn that magic age of 50, make sure you're doing your catch-up contributions in the 401k. I'll talk about the amounts in a minute. But with ExxonMobil's plans to do the catch-up contribution, you actually have to go in and tell them the percentage that you're automatically contributing through your paycheck does not adjust for catch-up contributions. So if you hit 50, make sure you get it done. Increase savings in addition to retirement accounts. So if you have the ability from a cash flow perspective to save elsewhere, frankly, as I just mentioned, there's some great companies that are going to get through this. And like I said, I think are going to be stronger than where they are today or where they were even going into it 4 weeks ago. And then also consider backdoor Roth conversions. So to kind of put a little bit of perspective on all of this, I wanted to talk about the differences between IRA accounts and the differences between Roth IRA accounts real quickly. So with IRA accounts, they grow, you put money in on a before tax basis, they grow completely tax deferred, and when you take the money out, you have to pay ordinary income. Now with IRA accounts, you can put $6,000 in if you're under the age of 50 and an additional $1,000 in for your catch-up contribution if you're over 50, so 7,000 total. You can put it in and not take a deduction. It doesn't matter what your income level is. You can put it into a traditional IRA account. Now, you also have the ability, dependent upon your income and if you're participating in a 401k plan, to put it in and potentially take a deduction. So if you're covered by a plan, meaning you're participating in an employer's 401k plan, and your household income is over 124,000, excuse me, I didn't mean to click. If your household income is over 24,000, then you're not eligible to take a deduction. And if you're single and you make over 75 grand and you're covered by a plan, you're not eligible to take a deduction. Now, if you're married and one spouse is covered by a plan, if you make to over 206,000, you're not eligible to take a deduction. So IRAs are retirement vehicles, great to get money growing tax deferred, but I also love to compare IRAs to Roth IRAs. Now, a Roth IRA is where you put money in on an after-tax basis. It grows completely tax-free, and as long as you've owned that IRA for over 5 years and you're over the age of 59 and a half, the money comes out completely tax-free. Now, one would automatically assume, why not put everything into a Roth? Well, we'll talk about what makes sense and what doesn't in a second. But you can naturally understand that we're highly inclined, if we can, get money into a Roth. Now, the reason that it's difficult to get money into a Roth is because there's income caps that phase you out on having the ability to do a Roth. It's the same contribution amount, so $6,000 if you're under the age of 50, additional $1,000 if you're over the age of 50. But if you're married and make over $206,000, you can't even do a Roth contribution. You get phased out. Now, there's another way to get money into Roths, which is what are called Roth conversions. Now, with Roth conversions, there's actually no income limit to do a conversion of a Roth. I'm going to get into a lot of detail in a minute talking about 401k conversions into Roths. Hold the thought because I'm sure there's some questions coming in on that. But with Roth conversions, the tolerance is your ability to write the tax check on what you're converting over to a Roth. So a Roth conversion means that we're going to take money from an IRA account or 401k account and make the decision to pay ordinary income on it now to move it over into a Roth. Now, some might say, why would I do that? Well, if we're in a low tax bracket now relative to where we're going to be in the future, well, that might make sense. If we're going to be in a higher tax bracket later, then that may or may not make sense. And for some of our clients, especially once they retire, well, there's a good probability that the early years of their retirement, they're going to be in a lower tax bracket than where they are while they're actively employed. And so it might make sense to look at converting portions of IRA accounts over to Roth IRA accounts. All that matters, you can do theoretically an unlimited amount of conversions, but you have to pay ordinary income tax to do that conversion. So it's your tolerance with writing that tax check. All right, contribution limits to retirement accounts. So 401ks, 403bs, Roth 401ks, you can put $19,500 into a 401k. You can put an additional $6,500 into a 401k if you're over the age of 50, so a total of $26,000. There's a defined contribution plan limit of $57,000 of total contributions if you're under the age of 50, and it's $63,500, of total contributions if you're over the age of 50. So some might say, please translate that to English for me. Flip the page again. $63,500. So let's just say you're over the age of 50. Let's say that you can put $26,000 in between your catch-up and your contribution. So that's $26,000 of the $63,500. Let's go ahead and say that your ExxonMobil match is $14,000. So that brings the total amount that's gone into the 401k account now up to $40,000. That means that you have the ability to do an extra $23,500 into the 401k plan every single year. So something to be mindful of, because I do think that there's a tremendous amount of value in maxing out the before tax. I also think there's a tremendous amount of value in getting some after tax in there, and I'll talk about that in a minute. But one of the questions I get a lot is, should I do Roth 401k contributions or should I do pre-tax 401k contributions? I would say without a doubt, if you are in the later stages of your career, you should absolutely be looking at doing the pre-tax contributions, before tax contributions. And the reason is because, and I'll show you a slide in a second, but when you're in the highest possible brackets, why would we want to give up the ability to have the pre-tax amount reduce our taxable income? So if you're in the 32% bracket, for example, and all of a sudden that, just saving 26,000 brings us back down to the 24, well, that makes a lot of sense. And why would we do that when we're projecting that we're going to be in ultimately lower tax brackets in later years? Now, some could make the argument that they'll never leave the higher brackets. Fine, I can understand that, but that's not the case for most people. And especially when we're in high tax brackets, it absolutely makes sense to look at doing the maximum amount that we can pre-tax. Now, in terms of savings priority, the next thing that I want to see people do is do your backdoor Roth contributions now. So for anybody who doesn't know what a backdoor Roth contribution is, this is actually where, when I was introducing Roth IRAs, I mentioned that you can do conversions. Well, I also was introducing IRAs, and I said that you could have an unlimited level of income and do the contribution to a traditional IRA. So this is a strategy where you can actually get funds into an IRA, and assuming you do not have an IRA, that's the most critical part of the strategy, you do not have an IRA, then you can actually convert them over to the Roth IRA and pay absolutely nothing in taxes. Now, the reason that I'm saying do them now is because the counts are down. If we have the ability to get money into an environment that's growing tax-free forever now, and we believe that the market will be higher at some point in the future, especially when it comes to retirement savings, then it makes a lot of sense to get the Roth contributions done now. Now, we still have until April 15th to do the backdoor Roth contribution for 2019. and now you can do your 2020. So if you actually have the ability to sock away $14,000 for husband or wife and you don't have IRAs, this is a phenomenal strategy to consider. The reason I said April 15th is IRS has not clarified the tax extension deadline yet for retirement contributions. They have moved tax filing all out to July 15th because of coronavirus, but they have not clarified if we can do retirement contributions all the way up until the 15th as well. So for now, I'm just saying, you know, it's March 24th. Consider doing it if you haven't done your 2019 yet. All right, tax loss harvesting. Now, this is something that if you have non-qualified accounts, a non-qualified account is an after-tax account. For a lot of folks, you know, it would be the easiest way of describing is your checking account is a non-qualified account. One of the things that we're experiencing right now is pretty much across the board, assets are down. And a great example, some of you might have restricted stock accounts that are sitting over a computer share. Well, most likely, I can almost guarantee those shares are now at losses. Maybe one of the things that we consider is selling some of those assets to harvest the loss. So help explain this a little bit better. You know, a capital gain or loss is unrealized if you own the asset and you have not sold the asset. A realized gain or loss is when you actually sell the asset. So if you bought ExxonMobil stock at $70 a share and today it's at 37, well, if you don't do anything, you just still own it, it's an unrealized loss. It's still a paper loss. If you go through and you sell it, then you actually will realize the loss. It generates a realized gain generates a tax liability, but a loss can offset those gains. So the reason that we're saying we should consider doing this is because, frankly, it might make sense to harvest the loss. And even if it's in 2020, we don't get other taxable gains to be able to offset, losses can carry forward into the future. One thing to be mindful of with this strategy is just be careful with what are called wash sales. So a wash sale was designed to discourage people from selling securities at a loss simply to claim the tax benefit. So what it's saying is if you sell a security at a loss and then immediately purchase what they consider to be, the IRS considers to be a substantially identical security within 30 days, they disallow the loss. So going back to my ExxonMobil example, let's say we had shares we bought at 70, let's say we sell them at 37. So we're going to realize that $33 per share loss. We can't immediately go back and buy ExxonMobil stock. But that's not to say we can't go back and buy another stock that we believe is going to rebound faster than ExxonMobil, as an example, as long as it's not what they deem substantially identical. Now, if you end up actually having the loss, it gets disallowed. What they end up doing is they actually add it to the cost basis of the repurchase. So ultimately, it looks like you actually end up having a bigger gain. Now, wash sales do apply to all accounts across all institutions. They also apply to transactions in spouses' accounts. So you can't do it in a husband's account and then buy it back immediately in the wife's account. The IRS also has ruled that when an individual sells a security at a loss and then repurchases the security in theirs or their spouse's IRA within 30 days after that loss is also subject to wash sale rules. So don't think that we can sell it in the 401k, for example, which there would be no reason to do that, or sell it in the computer share and then immediately buy it back in the 401k. You can't do that. That would still disallow the wash sale rules. Also, it does apply to ETFs and mutual funds as well. So I just had a question, is selling a passive S&P 500 fund and then buying an actively managed S&P 500 substantially similar for tax loss purposes? By IRS standards, the answer is yes. That is considered substantially similar. What I would recommend is if we're going to sell an S&P 500 fund for a loss, we should look at like doing the Dow, an index fund on the Dow or the Russell 2000 or some other relative benchmark that's not identical to the S&P 500. There's some gray area here, but it's one of those things that we don't want to necessarily have to deal with loss rules associated with that 12 months from now when we go to file our taxes next year. Couple things on loss carry forward rules. A tax loss carry forward or carryover is a provision that allows a taxpayer to carry over a tax loss for future years to offset future profits. So that's something I just mentioned. The tax loss carry forward can be claimed by an individual or business in order to reduce future tax payments. So translating that into English, let's say, for example, we realized $30,000 worth of losses in 2020. That means that in whether it be the remaining portion of 2020, if we have 30,000 of gains, we can offset it completely and sell those proceeds and be net neutral, but we can also defer them into future years. Now, let's just say hypothetically you never have gains in the future. I mean, I hope that's not the case, but you can actually also use those losses to offset ordinary income up to $3,000 per year, and you can use those all the way until you actually run out of money. I had a question come in. So say I sell some ExxonMobil shares to harvest the loss, but not all the shares in the account. Do dividends on the shares that are used to buy additional shares trigger a wash, even if it didn't actually go to buy new shares? No, dividend reinvestments are excluded. What I would recommend is that the dividends off the shares you sold, so sometimes you want to be careful associated with what the record date is. You want to be mindful of what those are if they're buying new shares, because that could, if dividends off the old shares buy new shares, then that could disallow the loss. All right. So Roth conversion strategies. Now I was already talking about this a little bit, but I'm going to get into a lot more detail. But we absolutely should talk about considering converting traditional IRAs, 401ks, 403bs to Roth IRAs or Roth 401ks while the assets are down. We want to be very mindful, though, what your current tax brackets are versus what we project your future tax rates are. This is another one of those charts that Pete helped me build, but it's showing what your average tax rate is. Average tax rate is versus what your marginal tax rates are. And so what we're really trying to say is, if your effective tax rate, what you actually pay in taxes, is going to be lower than what your marginal tax rate is, why would we want to actually give up the ability to have the pre-tax reductions? But if we believe in future years we're going to be higher than we are today, then we absolutely might want to consider looking at conversion strategies. So for example, the in-plan stuff, I've got a couple things coming up here in a minute, but this is really specifically one of those strategies for retirees that makes a boatload of sense, especially while accounts are down. And a lot of people have been pushing back saying, well, why would I do it right now? The accounts are down. Well, I'm going to come back to you and say, look, great example. If you've got some ExxonMobil shares in an IRA and the plan is to still hold them for long term, and those assets are down right now, but we believe that they're going to go up, why not convert those shares over to an IRA so all of the appreciation is now tax-free from that point of conversion? So again, a strategy that if we believe in the future your tax rates will be higher than you are today, which for a lot of retirees that is the case, especially ones that have retired in the near term, it's something to consider. Next slide is just showing an example of something. This is more of a retired strategy than an actively employed strategy. But let's just say somebody retired in 2019, and then all of a sudden in 2020, their tax brackets were significantly lower. And ultimately, we were looking at some period of time here where they got very, very low tax years. But then when they reached that magic age of 72, we're required to start taking money out of retirement accounts, specifically IRAs and 401k accounts. And those required minimum distributions, next thing you know, move them from being in the 24% tax bracket to taking them up to the 32% tax bracket, and then ultimately taking them up to the 35% tax bracket. So why not consider going ahead and doing some conversions in earlier years while we were going to be in these low tax brackets, do some conversions to then smooth out the curve so that you have less years that those required minimum distributions are actually going to impact your tax rates. And so, this is just a base example of showing somebody what their RMDs are going to be if they did nothing and they just let their accounts continue to grow, versus if they just did bracket bumping up to the top end of the 24% bracket. And you can see right out of the initial gate, first year of RMDs for this person, all of a sudden they've got about $120,000 less of a required amount that they have to take out of these accounts. Now, there's another part of this that also will benefit, especially if you're still in the position that you're going to be leaving money to heirs. The Secure Act passed at the end of the year, and it actually moved the required minimum distribution age from 70 and a half up to age 72. That's the great part. The bad part, though, is that they actually changed the ways that heirs inherit retirement accounts. So what was previously, the heirs were able to inherit your IRAs and do what's called a stretch provision, so take their required minimum distributions out over the rest of their lives. That's no longer available to them. Under the Secure Act, which again passed at the end of the year, now when an heir inherits a retirement account, they've got to take it out over a 10-year period of time. So if your heirs are standing to inherit any amount of money, you want to be mindful of what that will mean to them from their tax perspective, potentially as well. So I'm talking about a strategy that not only makes sense to benefit you, where it's going to reduce the required amount that you're going to have to pay, but I'm also talking about a strategy that has an ancillary benefit of also benefiting your heirs, because we're getting money out of your name, out of your IRA accounts into a Roth account for you. So it's going to grow tax-free for the rest of your life. And then when they inherit it, they actually have 10 years that they can leave it in the inherited Roth IRA before they have to take all that money out. So it's a great strategy to consider. And I think it makes even more sense if we know we're going to be doing Roth conversions this year to look at converting Roths while the accounts are down, especially because we do believe that ultimately the markets will get back on track. It may or may not be in 2020, to be perfectly honest. We do believe it will be, but if it's not, this still makes sense while the assets are down. Let the growth be in a tax-free environment. All right, couple things with regarding to those who are actually still working. Now, and I know there's a lot of chatter about this on the Yammer, but with Yammer, I know that there's a lot of people talking about converting within the savings plan over to the Roth 401k. Can you convert your tax paid without having tax implications? Can you convert your after tax? So a couple clarification points. When we talk about converting tax paid, we're specifically talking about what's listed as your pre-86, your pre-87, post-86 tax paid contributions. We are not talking about what's listed as your after-tax contributions. Big difference here. The tax paid is what you put in on an after-tax basis. The after-tax amount includes all of the growth. What I'm specifically talking about is the tax paid. Now, one of the strategies that we can look at doing is actually withdrawing the tax paid balance from your savings plan and then putting it over into a Roth IRA outside of the savings plan. Now, in order to do this, you actually have to withdraw what your tax paid balance was, and any attributable level of gain on it has to be rolled over into an IRA account. Now, the technical verbiage is it is a withdrawal. It is not a conversion. It's very different. I'll talk about conversions in a second. But one thing you got to be very careful for, if you have very low cost basis ExxonMobil shares, so highly appreciated stock or at this point appreciated stock, you might still have net unrealized appreciation. And NUA is a strategy that I still believe people need to consider, but it's something that we want to be very strategic. So if we go and we withdraw all of the tax paid credit balance out of your savings plan, we're going to have an implication on your NUA strategy. Something to be very careful about. And one thing that I would highly recommend, if you're going to do this strategy, have an advisor on the line. Voya is not always the most attentive to these types of needs, but I would say that having us on the line where we can help navigate what the numbers are makes a whole lot of sense. Big thing with it though is you can take the tax paid out, but you got to take the gain out. That will still lead to a tax-free distribution, but again, it can have material implications on what you want to do with the NUA. All right, so the big topic of conversation I know that's on the Yammer board is doing conversions within the plan. And a lot of people are saying, why don't I convert my stock while it's down right now and move it over to the Roth 401k side of the plan so that the gain's tax-free over there. So a withdrawal is very different than a conversion within the savings plan, which can absolutely have material unexpected tax implications. Be very mindful of that. So employees that are under 59.5 can convert a portion or all of the balance of their after-tax and their general accounts to the Roth conversion accounts. However, they cannot do any before-tax accounts converted. Now, employees that are over 59.5, they can actually convert all non-Roth accounts over to the Roth conversion account. Now, kind of where I was going with this is the basis of your ExxonMobil stock does not have any matter in terms of plan conversions. You know, most attribute the cost basis to shares to be in the pre-tax account, But for tax purposes, everything in the pre-tax account has a basis of 0. Most people would not know what the basis of your stock is. ExxonMobil is very unique in that they keep every single record or basis. The fact that you have a loss on it in a retirement account doesn't matter for conversion purposes. The only thing that matters is what that stock is worth. So when people select higher cost basis shares to either sell or convert, they're imagining that the IRS knows that the cost basis will in fact, that the cost basis will have an implication here. That's not actually the case. The only person in the world who knows that basis is you. Now, when we do these conversions, if we're converting ExxonMobil stock over to the Roth account, Voya will require you to liquidate the shares to complete the conversion. And then there's a 5-day period between when you liquidate the shares and when those shares manage to get over in the Roth account. So it's something to be very, very mindful of if we're doing this, but it also could potentially have a tax implication. And here's an example of that. So let's just say the entire after-tax account is 60%, the entire after-tax account is 60% tax paid and 40% of it's the gain off of that. So if they convert 100% of your after-tax account to a Roth, in that example, 40% of that's going to ultimately become taxable income. If you convert 50% of the after-tax to a Roth, 40% of the 50% is going to be taxable income. If you convert 10% of the after-tax account to a Roth, 40% of the 10% becomes taxable income, and thereon. I just had a question come in. What's your thought on selling higher cost basis stock and buying stock back a day later to create stock that could take advantage of NUA in the current environment? This is subject to market volatility, of course. Yeah, so to be honest, selling higher basis shares to buy lower basis shares to get more low cost basis stock, I think it really is going to be case by case dependent on your NUA strategy. Because if you have a lot of tax paid, I do genuinely believe that NUA still has a purpose in a person's portfolio. But I also believe using any excess tax paid you have to go to a Roth also makes a lot of sense as well. Having after-tax assets is great, having tax-deferred assets are great, but having tax-free assets are also great. So the benefit of NUA ultimately is to get you a leverage off of the amount of tax paid that you have, getting that stock out to give you the ability to sell stock potentially at 0% capital gains rates, or just ultimately at 15% to keep your tax rates low. That makes a lot of sense. But at the same time too, we got to look at your situation to see how much stock exposure you have, if it makes sense to sell the high basis stuff to rebuy it back at lower basis. Ultimately every person's situation is going to be a little bit different. The big criticism I have is it's impossible to time transactions within the savings plan. And as volatile as the markets are right now, you're only allowed to get the average price the following day on a buy or a sell. I mean, an ExxonMobil yesterday went up, I think it was close to 10%. Today was up about 4%. I mean, so depending upon when you do it, you actually can harm yourself on a relative basis. So what I would say is let us redo your NUA analysis before you make that decision, because I think it could make sense, but we want to obviously make sure we're doing it more cohesively in conjunction to your overall plan before we actually do that. All right. Nice segue to talk about what to do with ExxonMobil stock right now. This chart is nothing but depressing. It's a little dated at this point. Stock's had a little bit of a recovery, but effectively ExxonMobil hasn't seen levels this low since September of 2002. ExxonMobil has a lot of different things going on right now, more than just what's going on with reduced demand associated with the coronavirus. They've got free cash flow issues themselves. There's also lower crude prices are also making it very difficult to generate profits. But the one thing that I would say in the near term, the stock is still at a pretty attractive price. Now, dependent upon how much you have, I'm not going to necessarily say, let's go buy a whole lot more. But I would also say this is not necessarily the time to be selling the stock. So this is just a snip from the different research services that we follow. Now, I will tell you across the board, every analyst that we're following right now has reduced or revised down their price targets for ExxonMobil. 4 weeks ago, the consensus average was around $73 a share. Right now, that consensus average has now dropped. This is of the 30 different services down to just under $54 a share. I would argue that 54 is better than 37 where we are today or where we were. that it still makes sense in the near term to consider holding on. And I do believe that the dividend will stay intact. I know Darren Woods doesn't want to be the first CEO in history to cut the dividend yield. So I'd say in the near term, I'm in the hold category. I'm not saying sell it. There is obviously a chance that it could continue to go lower. But I ultimately think that you look at what happened with Chevron yesterday. They announced that they were going to cut 20% of their cost structure. Stock went up 24% yesterday. So we're in a very volatile environment for pretty much every asset class. But I would also argue for a lot of the energy companies that are at these depressed valuation levels that I think in the near term, let's hold on, reassess. But it's also bringing up the conversation of how much exposure do you have? And I go back to that asset allocation chart. How much stock do you have relative to your entire asset base? In retirement, we're going to be big advocates. Get you down below 10% as fast as we possibly can. And truthfully, it's kind of the buyer's dilemma where a lot of people, they've gotten very emotionally connected to the stock where we were continuing to hold on for 80s or 90s again. And ultimately, now we have this environment. So I think that where we're at now is ultimately going to remind people that we do need to be mindful that a concentrated stock risk can absolutely be detrimental to a retirement portfolio. And even though the dividend is attractive here at 10%, whatever the number is now today, it's definitely not the only asset that you should be holding in your investment portfolio. And we want to be very strategic in terms of the prices that we're looking at selling. The only struggle I have with the whole conversation is I do believe that a lot of asset classes are going to bounce back faster than the energy companies in their entirety. So be mindful of that in terms of how much your overall exposure is. We're more than happy to talk to you about what we think is an appropriate allocation for your situation and make sure that we're absolutely bringing in line what your risk profile and tax needs are as well. Someone asked me the question if, we're seeing a lot of insiders buying ExxonMobil stock. Candidly, I would not be surprised by that. It's hard to beat the current price. I mean, you're getting a 50% discount on the stock. I mean, at the end of the year, we were at $68 a share. I'm not surprised to see insiders buying the stock. It should give you some level of encouragement that they still have faith and conviction in the company, but it's also a pretty good price, to be perfectly honest. Now, don't take that as my recommendation to go buy more shares. Let's talk before we go and reallocate. All right. Want to try to wrap things up. I know I'm going a little bit long here. Sorry. So some strategies to consider now. Like I said earlier, the biggest takeaway, have a plan. Make sure you have a budget. Understand what your cash flow needs are and what your future expenses are. Understand your long-term risk profile. Now, if you have goals and time horizons have not changed, your investment portfolio should not change. Your risk profile should always take into account short-term and long-term needs. Making decisions out of fear or greed is not an investment strategy, period, the end. Now, if your risk profile has changed, we can have that conversation. If we want to generate tax losses, as I talked about, maybe we can talk about that and then what we're going to reallocate towards after the fact. Increase savings in retirement accounts and after-tax accounts. Consider tax loss harvesting. Consider converting tax paid to a Roth IRA outside of the savings plan. Also, interest rates have come down. Consider refinancing existing debt. And one thing I'd say is, truthfully, if you have an advisor right now, if you haven't heard from them in the last 4 weeks, they might not be the best advisor for your needs. So definitely something that we wanted to have a discussion about. I got a couple questions that have come in. I'm just going to finish this. As I mentioned earlier, we do provide one-on-one financial consultations, absolutely no cost, absolutely no obligation. Please feel free to take us up on the opportunity. We've got great resources that we've built out that are very, very customized for ExxonMobil's benefit plans. I probably demonstrated that today. And here's just some of our contact information. So any thoughts on 401k savings allocation moving forward within the options of our plan? International funds seem to be the most risky. So that is a great question, to be perfectly honest. And my answer is going to be, it really depends on your risk profile. I do want to make sure that people remember the fact that your lump sum is part of your overall investment strategy. I do think in the near term that bond units are going to be risky because I think interest rates are going to continue to be volatile. And as I mentioned earlier, bond prices and interest rates move inverse to each other. And I think as interest rates rise, the value of those bond units are going to go down. and also because you have the pension lump sum built in there. I do think that what is going to rebound the fastest is going to be U.S. large cap. So I do favor equity units right now. But if no one has, if you don't have a diversified strategy with the extended units and the international units, I do think you should consider having a piece in those. I'm more than happy to have a discussion one-on-one on your needs. I don't necessarily want to give a carte blanche recommendation for the whole group because there's a lot of people on here. But I would absolutely say, I think it's important to be diversified. And I'm not necessarily a huge fan of bond units right now. I also had a question on no RMDs on Roths for heirs. So this is going back to the question related to transitioning assets to Roth accounts. So RMDs are not counted for Roth IRAs while they're in your name, but they are counted. RMDs are not counted for Roth IRAs while they're in your name, but when your heirs inherit a Roth IRA, they are still subject to that 10-year rule. So it's one of those things that if an heir is inheriting a Roth IRA, I am a very big advocate. If they don't need the money, let's go ahead and absolutely have them keep the money in there for 10 years so they can get an additional 10 years of tax-free growth before they take it out. Because the new RMD rules under the Secure Act are absolutely requiring people to transition assets to their kids where it's a 10-year period of time. It is not, they have to do it incrementally every year. They just have to take the entire amount out over 10 years, within a 10-year window. And same applies to, that 10-year rule applies to 401ks, TSPs, IRAs, Roth IRAs, Roth 401ks. So something to be mindful about. But that's another reason why if legacy is still part of the planning conversation, love getting into the Roths as best we possibly can. How does a retiree who plans to leave money to their heirs determine how much IRA to convert to Roth IRA? What are the criteria to consider? Great question. So I mentioned Bogart Wealth is real big on tax optimization. Part of what we're doing, especially for a retiree, is every single year we build out a tax pro forma for our retired clients, because what we're wanting to look at is where's our taxable income coming in at that year. What adjustments should we be doing? Because dependent upon any given year scenario, like when ExxonMobil was up, we might have harvested some gains for ExxonMobil stock. If you were in the 12% tax bracket or lower, your long-term percent capital gains rates are actually 0%. That's one strategy to consider. But the other one is this conversion strategy. And so the short answer to the question of a retiree who plans on leaving money to their heirs and how much to convert to the Roth, I think it needs to be in conjunction with your long-term plan, because I showed that example earlier where that household went from the if they did nothing, they went from the 12% to the 22% to ultimately to the 28% to the 33% and then to the 35% brackets. If you're in a situation where for you're in a low bracket for a period of time, but we absolutely know that we're going to be in a higher bracket because of RMDs, then it absolutely makes sense to look at what the marginal brackets are up to a certain threshold. Does it make sense? So like for that household in that example I gave earlier, it made sense to convert up to the 24% bracket. So just something to be mindful of as we're setting up your allocations and your conversions. But for every one of the clients that we're working with, we're having those discussions on a one-on-one basis. I'm going to go ahead and wrap up for today. I apologize, I went a little longer than I thought I would, but please feel free, email me or any one of our team members if there's any questions that I missed today. We'll send out the slides to the attendees once we have them ready to go. Once they're done through compliance. And if there's anything that you have questions on after the fact, just let me know. Thank you very much for attending today. Appreciate it.